Soji, it's great to have you in the studio, and let's just start from there. Why are you rating the top tier banks right now? Clearly, those are the banks that a lot of people are very interested in Nigeria.
Okay, first and foremost, FY11 results have been out, and we had a report that came out just before those results came out. So on the back of those numbers, and I think more importantly, the switch from Nigerian GAAP to IFRS. Okay, the switch from GAAP to IFRS is quite significant. And if you simply look at the results of the banks for FY11, you find out that the impact on profitability for the banks is quite dramatic. GAAP versus IFRS.
Right.
So, and I think the biggest change where you see that is on the impairment charges line. So, right from there, okay, we had to revise our forecast. We also had meetings with management, and we had to upgrade our forecast for some banks like Access Bank and First Bank. For both of them, we had to upgrade both of them to buys. They are not both buys from hold on our recommendations.
You mentioned the IFRS reporting as one of the key factors driving this, but can you just give us a little more clarity on the impact that is having on those numbers?
Okay, well, there's two major things that impact the P&L. The first one is on the interest income, or should I say, on the funding income line, where you see a move of some items which previously were classified as fee income, now they're classified as interest income, and the overall interest income on those interest-bearing assets will be discounted over the life of the loan, as opposed to previously booking them upfront. Okay, so what you're just seeing is a movement from fee income to interest income.
Right.
So the impact of that is behind NIMs under IFRS versus what you had under Nigerian GAAP.
Okay.
I think more importantly is what you see on the provisioning line.
Yeah.
The provisioning figures under IFRS will be much lower than you see under GAAP. And that's because under IFRS, the banks are considering the value of their collateral.
Right.
So if you just compare FY11 versus GAAP versus IFRS, for at least 3 of these banks, you see between 20 to 40% lower provisioning charges under IFRS compared to what reported on our GAAP. This is likely what you see for 2012.
Right, so you've raised your forecast, so clearly you like these banks even more today. But let me play devil's advocate here. What other risk could be in the horizon that perhaps may just come out and surprise the market to the downside? I don't remember last year we did see some surprises in terms of NPLs. So looking forward now, what could be the possible surprises here?
I think first it's important to highlight that we're still quite conservative for some of these banks, and we expect some of them to surprise to the upside. But that notwithstanding, we still think credit risk could still come up. Maybe not this year. It could be an issue in another about 3 years thereabouts, probably about 2015. We think what's happened with the cleanup of last year is the banks have just bought some time. For some of them, the improvement in risk management has not been that dramatic. Right. Okay, so what AMCON has done is to take off these NPLs, but given a different scenario of events, okay, if all prices should move the wrong direction, you can then start to see another set of issues coming up. Yeah. Okay, we expect, we like to see the government clear up this downstream petroleum issue. Right. Okay, there's some risks here and there that are probably homebred. Okay, some of them are external driven. Right. So, but we think given what AMCON has done, those risks are probably not significant for 2012. Okay, so this year we should actually see quite significant improvement in earnings for the banks.
So hopefully risks are mitigated.
Yeah.
Okay, but let's talk about what you highlight as the key differentiator, cost cutting. And maybe we should talk about the scope for that for many of these banks today.
The scope for that is, is quite huge, especially, and I think one key analysis we did there was Zenith versus GTB. Right. Okay, you find out that Zenith Bank simply has a huge opportunity to improve on the cost line. They deliver much more revenues than GTB, but first of all, they have probably about double or triple the amount of branches GTB has. Secondly, they have about triple the number of staff GTB has. Okay, so what you find out is at the end of the day, Zenith Bank delivers just about the same level of PBT as GTB. But GTB does that on significantly lower level of resources. So they're much more efficient and they're able to deliver those revenues to throw up the profits. So
what you're saying, in a sense, is that they can look at the branches, they can look at their head count. Those are areas that they can.
Yeah, but interesting thing here is Zenith Bank is already doing that. Right. Okay, this year, there've been some right sizing of the business, especially top management level. Okay, we've also seen First Bank trying to address some of that as well. So we think by the time the benefits from this impairment improvements wears out, okay, the banks which are unable to improve on their, or should I say, become cost efficient, those will be the banks that become laggards from what you're seeing today.
Let's talk, let's go a bit technical here. I know from time to time you revise your forecast, clearly new information comes to bear, comes to the light, but to what extent is the stock market's performance itself having any bearing on any of these re-ratings? Does it have any bearing at all?
Yeah, because what we've seen is, for example, if you look at the valuations for these banks. Okay, you have some banks trading at 0.2 times book. A bank like Fidelity. The tier 2s are trading between 0.2 and 0.6 thereabouts. The tier 1s trade between 0.9 and 1.2 GTB at best case. Okay, so what's happening there is we haven't materially changed target prices for GTB, Zenith, or UBA. Okay, where we've really changed our target prices are on Access Bank and First Bank. First Bank, because we were quite, we had questions on the quality of their earnings, first of all for 2011 and even going forward. Some of those questions are still there, but given the the level of performance we expect under IFRS, their performance right from day one needs an upgrade. Right. And Access Bank, simply because of this M&A, we were very, very conservative. In fact, we think overly conservative in our last report that came out in February. Right. So we really did have to upgrade Access Bank. Now it's by 10 or 60 target price. And
of course, it has moved into the top tier after that.
Yeah, it's like a top tier bank.
All right, Soji, thanks so much for joining us.